Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Assistant Director Rob Knapp. It's great to have you with us this morning. The soft landing, the long-awaited, much-anticipated soft landing, feels like it's closer than ever, especially with the Federal Reserve seemingly ready to cut rates. But not every best case scenario is a perfect scenario. Now we're going to have UNC Kenan-Flagler professor Greg Brown with us to talk about that, talk about the trade-offs that are involved in the economic slowing that will bring us a soft landing. He's also going to talk about the jobs numbers from this morning, which may tie into that subject greatly, and some other economic topics of interest as well. He'll be with us in a moment. After he does his presentation, he will take questions from you in the audience. You can ask those questions at any time during the presentation by using the Q&A function at the bottom of your screen. If you are with the media, please include your title and organization with your questions so that we can prioritize your questions. If you're joining us by phone today, you can also join in the conversation. You can email me your questions at rob_knapp@kenan-flagler.unc.edu. We will be here for about 30 minutes today, depending on how many questions we get. So we hope you're going to enjoy the ride. With that, let me go ahead and introduce our Kenan Institute Research Fellow, Greg Brown, who was also our executive director for 8 years and still remains very involved with the Kenan Institute, we are happy to say, including giving us a Friday morning every once in a while to do the briefing. Greg, good to see you this morning. Hope you're doing well.
Great. Hope you all can hear me now. And there, now I'm on screen. Great. Yeah, thanks, Rob. Yeah, the employment report, certainly interesting. For the macro economists, the employment report is sort of like having a birthday 12 times a year. Always something to get excited about. And certainly this one's got some interesting stuff in it. So I'll spend a few minutes just kind of running through what I think the current numbers mean for the near-term economic outlook, put a little bit broader context in terms of what's happening to the economy overall and what it means for monetary policy, because I think this definitely has some serious implications for what we would expect over the next 6 months to a year in terms of monetary policy, and the market reaction is telling us just that. But then also want to talk about, okay, so let's say we really are seeing some softening now towards a soft landing or potentially something worse than a soft landing. What does this mean in terms of how different stakeholders in the economy would likely be affected? So with that, let me go ahead and share my screen. We can kind of get into the numbers. So the change in non-farm payrolls was less than expected, up 114,000 versus the expectation of 175,000. On top of that, there was downward revisions to the last couple of months, combined downward revisions of about 30,000. And so a bunch of that came off of the June estimate, but we also had a little bit weaker numbers from May. When you look inside of it, there's kind of interesting things to keep track of. People were expecting a small decline in manufacturing payroll. They actually fairly up positively. When we look at average hourly earnings, they were weaker than expected. So 0.2% growth in July versus expectation of 0.3. So a little bit weaker wage growth. Hours were also a little bit less than expected. So when we look at sort of overall wage growth, and we'll get into this more, it was basically flat in July. Maybe the biggest news was that the unemployment rate ticked up to 4.3%, which now we're off that very low unemployment rate that we saw last year of 3.4%, up to 4.3%. So it's still low by historical standards, but significantly higher than it was a year or so ago. And again, we'll get into this in a bit more detail. Part of the reason for that increase in employment rate was an increase in labor force participation rate. That is, so the number of people sort of that are of working age saying that they're a part of the labor force. All right, so let's dig into a little bit more of the details. So this still was positive job growth, still north of 100,000 jobs. Private sector employment was a little bit less than that. So there was about 20% of the jobs came from government employment, but those are still real jobs. It's just they're maybe less indicative of what's happening in real time to the private sector. So still a decent number, consistent with very long run averages for employment growth. And we think about demographics in the U.S. 100,000 jobs being created each month is not a terrible number. That's certainly not like a recessionary number where you would see job growth become negative, but it is quite a bit slower than what we've seen over the last year or so, and much slower than what we saw when the economy was recovering after COVID. So I would say that the current number is consistent with a stable job market. It's consistent with the elusive soft landing that the Fed has been trying to engineer for more than a year now. And the maybe more interesting statistic, and the one that I think is more salient to a lot of people, is the unemployment rate. And again, the unemployment rate has now ticked up to 4.3%. And when we look at this as part of a longer term trend, you see a few interesting things. One is that it's more obvious that we're off the lows now. What had been literally record low unemployment rates for the US, now we're off those levels. We've seen an acceleration in the increase in the unemployment rate over the last few months. And if we look back historically to the two prior recessions before COVID one was sort of unusual in lots of ways, so not indicative of sort of a typical business cycle. But if we look at the recession that happened around the dot-com bubble bursting and then around the global financial crisis, what you can see is that there was this acceleration in unemployment off of a low just as the economy started to tip into a recession. So I think there is a concern that if we look at historical patterns in unemployment rate, that this could be a negative indicator, something that's potentially not a soft landing, but more consistent with a hard landing, at least historically. As I mentioned, when we look at average hourly earnings, those have also continued to slow. We had a big bump in average hourly earnings when there was a labor shortage coming out of COVID, and not everyone had returned to the labor force. That has been consistently moderating, and that moderation has accelerated a little bit the last few months. So when we look at a year-over-year change in average hourly earnings, we're at a rate that is the lowest we've seen in the post-COVID period. One that's probably consistent with a stable economy in the sense that we know that inflation has been an issue, and there are concerns about a wage price spiral where if wages were growing too quickly, more quickly than the productive capacity of the economy, that would lead to supply-demand imbalances and accelerating inflation. So I think in many ways it's good news for the Fed that we've seen this moderation in average hourly earnings and to numbers that are sort of more consistent with a stable economy. That said, when we look at overall wages, they were flat, right? So we saw that downtick in hours worked. And so when you sort of aggregate across the entire economy, the sort of number of people that are working, the number of hours that they're working per week, and what wages are, that was sort of flat on a month-to-month basis. So that's maybe a little bit weaker than what the Fed would want. But again, that's just a 1 month print. So let's talk a little bit more about more broadly what's happening with the economy. We also just received the JOLTS data, which tells us how many job openings there are. That had reached a really extreme level, again, as we had labor shortages coming out of the COVID recession and people hadn't returned to the workforce. And the number of job openings has come down quite a bit off that peak. And the the way to read this, I think, is largely relative to historical numbers. So while we're way off that peak, the number of job openings is still relatively high by historical standards. And the job opening rate, which is the one on the left, is probably the better one to look at rather than just the number of job openings, because it sort of tells us how many openings there are relative to the number of employees. So even though that's come down quite a bit, it's still above, just slightly above where it was prior to COVID. So I think, again, this is maybe a normalization, depending on where you think the economy was prior to COVID. I mean, the Fed was trying to slow the economy down in 2019 as well. Potentially there's sort of a case to be made that the labor market's still quite strong by looking at job openings. So how does this all flow into inflation? I mean, that's been the biggest issue and really the driver of monetary policy decisions, and I think how people have been thinking about the macroeconomy in general. It's been hard to get a read on inflation dynamics this year because it's been a bit of a bumpy path. Inflation was clearly moderating towards the end of last year, and then we had a few prints earlier this year that suggested that things had leveled off or maybe even were ticking back up. And so here, this is the core PCE deflator, which is the Fed's preferred measure of core inflation, so excluding food and energy. And you can sort of see those most recent prints, depending on whether you look at the last 3 months or the last 6 months or on a year-over-year basis, you can kind of get different pictures in terms of what's happening to the trend in inflation. And in particular, that 6-month one is going up, whereas the year-over-year and the 3-month one is going down. But I think as you sort of take a closer look in terms of what's driving inflation, there is increased confidence on the part of the Fed that there is a deceleration in inflation. So some of the places we're seeing inflation are a bit stickier, but they're also a bit harder to measure. And I'm thinking specifically of housing and the way that housing inflation is measured is difficult to do. And because many people are in rents, it takes longer to sort of get a read for what's happening as leases expire and are renewed. But I think it's safe to say the Fed is comfortable with the idea that inflation is settling near 2.5%. The bond market, where you can get implied inflation rates from, also suggests that inflation has been stabilizing and is on a downward trend. So I think the Fed is relatively confident that inflation is under control and moving towards where they want it. So what does this mean for broader economic activity? It's very difficult to get a real-time read on what's happening to the economy. By the nature of economic data, it comes out with a lag. In some cases, they're quite long lags. Very often the data is revised. One of my preferred measures for what's happening in real time are these surveys that are done of purchasing managers, where they sort of ask them how things are going this month relative to the previous month. And we do this both for the manufacturing sector, and the orange line here is the manufacturing sector, and for the service sector, and that's the blue line. And the benchmark here is 50. So if the purchasing managers think that the economy is doing better this month than it did last month, the numbers will be above 50, and vice versa. So what we've had recently over the last year or so is interesting situation where the manufacturing purchasing managers were kind of bearish. The numbers were generally below 50, and people sort of just thought that manufacturing wasn't in great shape, whereas the services economy had continued to be, for the most part, above 50, and therefore that's consistent with expansion. But what we've seen just in the last month or so is that these surveys have both gone to be below 50, and in particular services has dropped below 50. And so that's a sign that, at least from business purchasing managers who you would think sort of have their finger on the pulse of what's happening in the economy, that there seems to be some increased signs of weakness recently. So how does this relate to very broad economic output, say the real GDP? Real GDP has been fairly strong. When we think about the relationship between people working in the economy and what the productive output is of the economy, there's sort of almost an identity there, right? The productive output of the economy is generated by people working. right? And the plug between those two is how productive workers are. So to sort of have a stable economy, have this proverbial soft landing, you need to see sort of stability in terms of the hours that are worked overall in the economy and how that relates to real GDP, so the total productive output of the economy. And it does look like that stabilized recently. So that in particular, we've seen fairly stable real GDP growth. We've seen a stabilization in this index of aggregate hours worked. And when we look at the actual GDP data in more detail, it does look like things have stabilized here. And in particular, these are the four main components of GDP in terms of output. That's household consumption. Those are the blue bars. Private fixed investment, that's mostly housing, and business investment. Think of it as CapEx spending. Those are the two, I think, most important ones. And if we look at sort of just what the sum of those blue and orange bars are over the last 4 quarters, you can see they've been pretty stable. So they've been in the two and change range over the last 4 quarters, which sort of suggests, a consistently healthy economy in the two most important sectors. A lot of the variation in GDP growth comes from swings in inventories and net exports that sort of very volatile on a month-to-month basis. So when you pull that variation out, it does look like the economy has been on pretty solid footing. And government expenditures have been a consistent positive there as well. Though what we really want to focus in on, because it is so cyclical, is the household and business spending part. All right, so what does this mean for the Fed? Are they really going to be able to stick this soft landing? I think that this employment report essentially guarantees that the Fed is going to ease in September. That was the expectation already. I saw, sort of the initial reaction. Some people were saying, "Oh, this means the Fed is going to go 50 basis points in September." That might be a little bit aggressive, but there has been a very significant change in terms of what the expectations are over the next 6 to 12 months. I was looking at the futures market for the Fed funds rate, and say over the next year, what the futures market expects the Fed to do. Up until a couple of weeks ago or so, they were expecting the Fed to ease, but fairly modest easing, slow, modest easing. So over the next year, that they would cut rates by around 1% or so. But just in the last couple of weeks, and then especially after the report this morning, that's turned into fairly aggressive easing. So now by the end of next year, the futures market expects the Fed will have cut 2 percentage points. Is that consistent with a soft landing? It would be, a soft landing with a pretty quick approach. So you might feel that soft landing, but it's also, I think, potentially consistent with the economy overshooting to the downside and slipping into a recession. I think recession probabilities are probably still elevated, but not extreme at this point. I don't expect that people are going to suddenly say, "Oh, the economy's for sure headed into a recession." But if we look at the relationship between the employment rate and the Fed funds rate historically, again, sort of let's abstract away from what happened during COVID because that was unusual. But if we look back at, say, what happened in the late 90s, with Fed policy, and then also going into the prior to the GFC, what we saw was the Fed, got pretty aggressive on rates, leveled things out. The unemployment rate started to go up, which means the employment rate was coming down, and they overdid it, right? So they were too tight for too long is another way to think about it. This period of elevated rates prior to the recession was in some sense too long, and the economy dipped into a recession. And so if we look at this period back in, say 1999, 2000, the period in 2006 through 2007, in each case, you can see the Fed fairly aggressively moved up rates, leveled things off, and then as the economy started to soften and employment rates started to decline, they started to cut rates, but it was too late. right? And so it does look a little bit like a replay of what happened in those two prior recessions in 2000 and 2007, 2008, in the sense that the Fed has clearly fairly aggressively raised rates, one of the most aggressive increases in its history. And we have seen the unemployment start to go up, and therefore the employment rate start to tick down. And so I guess the question is, how quickly are they going to cut, and is it going to be too late? Are we going to actually dip into a recession when we have a fairly large economic dislocation? So I think that's the real question right now. We'll get a lot of interesting data over the next few months to get a better handle on what's going to happen in the second half of this year. And it's worth, I think, thinking about what does this mean for different stakeholders in the economy. So those are all the slides I got. So let me stop sharing there. But I do want to talk a bit about, there's potentially winners and losers in terms of what happens to the economy and what it means for different sectors and even within sectors. So maybe start with the business sector. So, what are the pros of a softening economy for a business sector? Well, we're going to have a lower cost of capital. We just talked about how the Fed is likely to cut rates. It'll be easier to find workers, so there'll be less wage pressure. We're already seeing a bit of a weakening U.S. dollar as monetary policy eases relative to the rest of the world, or at least the expectation of that. Tend to see the dollar weaken. That's good for exporting companies, and lower inflation's potentially a benefit, but that sort of depends on the particular business. Are your input costs or your sales more sensitive to inflation? So that's a bit sector specific. But there's cons clearly as well. So obviously a slower economy is going to be lower domestic demand for business sales. The cost of capital may not be an issue for a lot of companies, especially fast-growing companies that are generating a lot of cash right now and have, almost no debt. Then, lower borrowing costs may not be important, and falling stock prices. So the stock market did not like the employment report this morning. So futures were down coming into the report, and then when the employment report actually was released, there was another step down in stock prices. And so we're nearing the point now where, I'd say a very strong stock market is showing some weakness. That's also a leading indicator. So there's a chicken and egg issue there, because the stock market will anticipate a weakening economy. But overall, I think a weakening economy is a net negative, right? You can say that there's some positive things for the business sector. A perfect soft landing might be good for the business sector, but a softening economy is in general not a good thing for the business sector. What about the government sector? Again, lower cost of debt is going to help the federal government with budget issues. Maybe more importantly, lower cost of debt would help municipal and state governments that are looking to borrow and have real interest costs associated with investments that are happening at the local level. Government sector's had a really hard time hiring, so a softer economy makes it easier. But then there's cons as well. Lower tax revenue. So if incomes really decline or property values decline, then that's lower tax revenue, and there'll be higher expenditures in the sense that certainly when you look at things like unemployment benefits, we've seen an increase in initial claims for unemployment and continuing claims. Those can be a budget drag at the state level, especially. So I think overall, a weaker economy, even if it's a soft landing, is a net negative for the government sector. So let's talk about households. Maybe that's the thing that's of most interest. So, what are the pros for the household sector? There are pros to a slower economy. Lower interest rates are definitely going to benefit people who are borrowers, right? And so those could be consumers with individual loans, credit card debt, car loans, and especially mortgage rates. We know that mortgage rates have gone up a lot, and that's in some sense priced people out of the housing market. And another benefit is lower inflation, right? A softer economy hopefully is going to be accompanied with a lower inflation rate. That could specifically be experienced in terms of more affordable housing, so lower rents or more affordable purchase prices. So those are clearly things that would benefit the household sector. But there's cons, and I make the case that at least on average, the cons are going to outweigh the pros. We'll see lower asset prices in terms of home prices. So people who are existing homeowners are going to lose some wealth if home prices actually decline, and clearly stock prices would tend to come down as well, as we've seen recently. There will be higher costs for some goods, in particular foreign goods, from that weakening US dollar. But the most important effect is just this weaker jobs market. So it's going to be harder to find a job for people who are unemployed. It's going to be harder for people to move into a better job when there's a tighter job market. And especially, it's going to mean lower wages overall in aggregate, as well as probably lower raises for people who are employed. So, maybe a perfect landing could be a good thing for the household sector, but a recession is for sure going to be an overall negative. So if that soft landing turns into a particularly bumpy or even hard landing, then that's going to be bad for the household sector. And it's going to be especially bad for lower income households, right? They may benefit more from lower interest rates because they're more likely to be borrowers than lenders. But they almost always lose out in recessions. And the reason is because they tend to have employment that's more sensitive to economic conditions, and their wages are in particular going to be more sensitive to economic conditions. So, not every historical recession is the same. In fact, they're all different. The current climate, we've seen kind of weird things happening with higher income professions. So in the tech industry and in finance and consulting and places that historically have been very high income professions, they've been quite soft the last couple of years. So maybe there's a little bit of more impact on higher income households. But I think without a doubt, hard landing or a very bumpy soft landing would be a bad thing, and disproportionately bad thing for lower income households. So it's interesting to think like everyone's been hoping for a softening economy, but just softening to an extent, right? Just softening to the point that we get back to equilibrium and then we have growth at sort of a sustainable growth rate. But I think there's, as you have a lower growth rate, as you get to something that's closer to a soft landing, the risks of a hard landing also increase, and that should be a concern for individuals and businesses as well as policymakers. All right, so I've used most of my time, but happy to stay on for questions that folks have. So Rob, I'll let you serve them up.
Great, thank you very much. Lots of good information in there, and I think you may have raised a philosophical question too. If you can feel a soft landing, is it really a soft landing? But we'll get to the more important questions before that. Dan Barkin at Business NC says Sahm rule just rose to 0.53. How significant is that in your view?
What, I missed the first part. What rate? What rose?
Oh, the Sahm rule just rose to 0.53, and someone asked, Sahm rule triggered? Question mark.
Yeah, I mean, I think that you always have to be careful about sort of the most recent data, because we know that there's noise. We know that things get revised. There's not clear, perfect transparency in terms of the current condition. So I think you can't be mechanical in terms of evaluating what's happening in the economy and markets and all of that, because every time is different, right? And in some ways, we think about business cycle, post-war business cycles. There's been a dozen, right? So when you think about inference around sort of a dozen observations, you want to be super careful. And then on top of that, the economy has evolved tremendously over time, so that the kind of mix of what we're experiencing in the economy today is quite a bit different than it was certainly 50 years ago, but even 20 or 30 years ago. So I shy away from wanting to make strong inference from any sort of individual kind of rules of thumb or indicators that are out there. Period.
Fair enough. We usually zero in a little bit on the local scene. So the idea of what triangle area CEOs might look at this jobs report and news in general and take out of this.
Yeah, it's places where there were strength in the current report, at least nationally, were in construction. Manufacturing, I wouldn't say was strong, but stronger than expected. Healthcare and government spending, or government employment, and those are places that I think the triangle has good good employment base, right? So if we think about healthcare, we think about state and higher ed type of employment, state government, higher ed type employment. So I think in that sense, the if there is softening here, it's softening that maybe we would feel less in the triangle than the typical national average. But again, it's going to be very specific to companies and industries, right? So if tech really is kind of going through a correction right now, then the more tech-oriented companies in the triangle might feel that.
Okay, very good. Well, in honor of the Olympics and the gymnastic competition, we're going to try and nail the dismount here. It's 9:31, so a slight hop, but in general, pretty good performance, I think. Thank you, Professor Greg Brown. As you said before we came on, it's always an interesting morning at the briefing. Thank you for talking us through this interesting morning. A lot to take out of this one.
Yep.
Let me also say thanks to the audience. We appreciate you being here. Say thanks to our other folks at the Keenan Institute, Cody Morris, Corey Powell, Robbie Passel, folks who make the briefing possible. If you are a member of the media and want to continue the conversation, we'd love to do that. You can reach out to me at rob_knapp@keenan-flagler.unc.edu to talk to any of our experts about any of the topics we cover, including some that you heard this morning on the briefing. We're looking forward to hearing from you. For everyone in the audience, we hope you'll take a look at our website, keenaninstitute.unc.edu. It's the slow summer months, but it's not slow on the website. We will have a new insight up from frequent host Gerald Cohen about one of his absolute favorite topics, productivity. That's on the site, and I will make sure to move it to the front page as soon as I get off of here so you can find it very quickly. It is well worth your time. That is all we have for today. We will be back next month. In the meantime, stay cool and enjoy your Friday. Thanks.